I think as an opening comment, say, as a lawyer, unfortunately, I'm tempted to say we are not involved in legislation. There were a few attempts, but they have gone down pretty badly with the press, although there would be sometimes, I think, a benefit to maybe getting external input from people who have to execute later on. Putting that aside, I think we all should keep in mind that regulatory action is driven by larger political interests. Maybe it should not be the case, but I think there is some connex to it. And I think this is what we see when we are seeing drafts of bills coming our way. And this is like we all know how it started. I mean, the last global financial crisis has sparked this huge appetite for regulation and for allocation, as Anthony said, of capital, of funds, of safety cushions into different segments. And mainly aiming at, say, public debt and protecting public assets, in particular those assets belonging to the, let's say, global economies, let's say the deposits of people. So protection is a big word. And sometimes you have to ask yourself the question, who is protected from what? That maybe results in these conflicting interests. People have to do careers and have a focus area, so you do the best for your focus area, but it's a largely complex thing. What does it mean for us in practice? Sometimes as a lawyer, I feel a little bit sorry for highly regulated entities like banks, because you can't be quick enough in implementing the ever-increasing change in the regulation. I mean, just understanding it, analyzing it, deciding how you implement it, say, sometimes the next step date is there. So first given point is regulation will not become, I think, less stringent. It is obvious that as a result of that, you look for an alternative. And that's the starting point. Alternative lending was an attempt to free up certain parts of a product, lending into specific real estate products, into other, say, asset products as well, and trying to take the view that we may take risk on a higher curve, but we can take that risk and we do not need to be regulated to the same extent, because there's less risk involved for someone who's making available capital to be invested through an alternative lender. That idea is simple, and I think it's quite convincing. However, if you think it through on a larger, let's say, economy scale, well, the lending markets are not separated. You can't say a bank is absolutely disconnected from an alternative lender. They both compete for the same clients, for the same projects. So naturally, the regulator then jumped on alternative lending platforms and started to regulate as well. And I think Anthony's point is very important. The focus then has also shifted to the sources of capital. Should you be allowed to invest in, say, making capital available for a bank or for alternative platforms? So my view on it is alternative lending will see more regulation. We will see pushbacks like we have seen in people saying, well, we need it, so please give us some headroom. And some of the restrictions, in particular in Germany, say we got over it. But I see that eventually, in the, say, far distance, people will have a new and clever idea to have an alternative investment platform. And then maybe again starting the cycle of the regulations.